One of the most important and possibly one of the largest financial commitments a company will make is in the area of inventory. For merchandising companies, inventory is the primary source of generating revenues. For manufacturing companies, inventory is needed to produce products that eventually will be sold to its end users. Because of the importance of inventory, businesses must control and account for inventories in a proper manner. Merchandise companies classify inventories using the term merchandise inventory, whereas manufacturing companies classify their inventory in three categories known as raw materials, work in process, and finished goods. For this class, we'll be concentrating on merchandise inventory. If you are to move on to managerial accounting or cost accounting, you will get a detailed view of the manufacturing company's elements of inventory. When we take a look at inventory, we've already mentioned that there are two different systems in terms of keeping track of inventory: the perpetual inventory system and the periodic inventory system. The key elements between these two systems are that the perpetual inventory system keeps track of inventory on a real-time basis. In other words, we always know how much inventory we have on hand and the cost of that inventory immediately after every sales transaction and after every purchase transaction. The periodic inventory system knows how much inventory we started with at the beginning of an accounting period, but does not know how much inventory is on hand at any given time during the period until at the end of the period we go out and count the inventory, value the inventory, and then use the accounting formula for inventory calculation to determine cost of goods sold. Which system you pick for keeping track of your inventory will depend upon the complexity of your inventory as well as the resources available by the company in order to keep track of their inventory. In today's world of computer technology, most companies are resorting to the perpetual inventory system. However, if the company is small and has few inventory items, they may find that it is easier to keep track of their inventory using the periodic system. In both cases, no matter which inventory system you use, a company needs to be able to take a physical inventory at least once a year, typically at the end of an accounting period. Some companies choose to take their physical inventory at the end of each month. Other companies will wait till the end of the year. You might ask, why do we have to take a physical inventory if we have a computer system that's keeping track of our inventory on a daily basis? Think about it. If we have a computer system, the computer is keeping track of the quantities and the dollar amounts of our inventory on our balance sheet. However, it does not know the actual movement of the physical quantities of the inventory or the condition of that inventory at any given time. The taking of a physical inventory is an internal control to ensure that the information that's being recorded in the accounting system agrees to the actual quantities on hand within the organization. The objective of the physical inventory process is to ensure that all inventory items have been counted and have been evaluated to ensure that they are in saleable condition. So one of the things that we want to make sure when we take that physical inventory is that we take the inventory at a time when we know that the inventory is not moving, so that we can make sure that all inventory items are counted and they are matched up to the information that's in the accounting system. You might ask, why is it so important to get inventory right? Consider the fact that inventory affects the financial statements in the balance sheet and the income statement. On the balance sheet, the inventory account shows up on the assets side of the balance sheet to show how much inventory the company has on hand at any given time. On the income statement, the cost of goods sold is the inventory that has been sold during the current period. So, if we don't get the inventory accurate and the valuation correct, the problem we're going to run into is that we will misstate the balance sheet and the income statement. The taking of a physical inventory is an excellent tool to ensure the accuracy of the accounting information. However, there are chances that inventory could be misstated either due to errors or irregularities. Now, errors are just mistakes, and hopefully the physical inventory will catch those mistakes. However, if it's an irregularity, sometimes known as fraud, we may have a problem in detecting whether the accounting records are accurate. There have been many fraud cases that have shown where management has used inventory to misstate the financial statements either by overvaluing inventory or undervaluing inventory so that we could manipulate the cost of goods sold calculation on the income statement. Remember the formula beginning inventory plus purchases, which gave us goods available for sale, minus the ending inventory gave us cost of goods sold. If we were to change the ending inventory either in quantities or in valuation, that would be a direct effect on the cost of goods sold calculation. Management is under pressure to show profits or to show financial viability on the balance sheet, so they may be pushed to either overstating assets or understating cost of goods sold. In either case, if they are intentionally doing this to misstate the reader, we have a case of fraud. One of the issues that we have to face at the end of each period is to make sure that all items that belong to the company are included in the physical inventory count and are included in the accounting records. Remember in a prior recording we talked about FOB terms. Free on board shipping point, or FOB shipping point, tells us that the owner of the property is at the time of shipment as it leaves the seller. FOB destination tells us that ownership changes hands when the buyer receives the item at their location. That's very important because if we have an item in transit, we need to determine the ownership at the point of transit at the end of the period. Another issue has to do with consigned goods. Consigned goods basically means that we as the seller will give inventory to another party to sell for us. Ownership still stays on hand with the seller. The person holding the inventory is merely a sales conduit to help sell the inventory, or a service provider who's working on the inventory, but they have no ownership interest. The ownership remains with the seller because of the consignment relationship. So keep in mind that what we need to do is to make sure that all inventory items are included in the inventory records at the end of a period. Understanding that FOB terms are important, as well as who owns the inventory in the case of consignment.